All right, so we're talking theta decay over time. So getting some questions about, why not sell the 90-day option or the 120-day option or go further out in time? There's more premium. So we're going to kind of talk through that and just talk about how decay comes into play and specifically to each expiration. So we're going to talk about the decay curve, which is something that I think is important for everybody to understand and kind of leads you into the reasons why we trade in that 30 to 50-day time frame. So let's do it. All right, so just the basics of theta. The key to understanding theta is that it is not linear, right? So this isn't a paycheck. You cannot count on theta coming out each and every day. It does not come out in the same fashion each and every day. This is a non-linear variable. It's a theoretical variable as well. It changes based on a lot of different things in the market. So theta will be influenced by changes in implied volatility, the price of the underlying, and of course, how much time is left until expiration on that option that you are trading. All else being equal, when we isolate all of these factors, IV increase, you'll see theta increase, right? So when volatility increases, extrinsic value increases, which means you'll see an increase in the potential decay of that option, especially if you do see a volatility contraction. So all else equal, volatility increases, theta will increase. Price change in the option or in the stock relative to the option. So when you sell a 30 delta put, the stock goes down, it moves closer at the money to your option will increase in delta, it'll increase in extrinsic value, it'll increase in theta. So you see a change in theta as the stock moves closer to your options or away from your options. And then there's obviously the piece of the passage of time, right? So theta increases as you get closer to expiration, right? So we know that all extrinsic value goes to zero at expiration. If you're looking at a 30-day option, moving from 30 days to 29 days is less potential value than going from 2 days to 1 day till expiration, because we know at expiration, all of that extrinsic value comes out of the option. So typically you see increases in theta as you get closer to expiration. It doesn't necessarily mean that the total remaining extrinsic value, though, of that option is going to be higher, right? So theta and value isn't totally connected. It is in some way when you get to like that 30 to 50-day range. But when you talk about like highest theta, it doesn't necessarily mean highest extrinsic value, because as you get closer to expiration, extrinsic value has to go to zero. That theta therefore gets higher. So extrinsic value will still decay as time passes, even if theta increases. So, just because value comes out of that option doesn't mean that theta isn't also going to increase, because there's only so much value left there. Overall, theta is a good thing, but understanding why it's high or low is more important. So short durations have less extrinsic value, but that extrinsic value on a day-to-day basis will decay quicker. And what that means is that there's more risk in that option, especially with those closer at the money options, those options that can go in the money. You're overall going to have more volatility in your P&L. So, that's why we're not always just looking for a super high theta number, and a theta isn't our main focus in our positions, because when you get to a certain point, if the high theta is due to low amounts of time, that means you have a lot of risk on the table. If your high theta is due to 30 or 40-day durations on your positions, that's okay. But when you have high theta due to short duration, that's when you can really get spanked a little bit.
Yeah, and when we talk about the Greeks and what is most important, which is what we'll kind of get into in the next couple of slides. I mean, theta, I think the big takeaway is don't hyper focus on a theta number, because theta is unquestionably the weakest link in terms of a Greek that's going to change your P&L day to day. Delta movements are going to be very important. Implied volatility crushes are going to be very important, especially around binary events. and theta comes in at like literally dead last. So understand the concept of theta, but don't hyper focus on theta and expecting this number to come out every single day, because all these other things are moving and having a much greater impact around your daily P&L.
For sure. All right, jumping to the next slide here. So this is a nice little visual that we put together for extrinsic value and option value versus theta decay. So we talk about how extrinsic value and therefore theta is not linear across the board. If you look at any underlying and you look at a weekly option, that option strike value is going to be higher relative to, 10 weeks out in time. If there's or 15 or whatever, you can't take, a $1 option that expires in 1 week and say that, okay, in 2 weeks, that option would be $2. In 3 weeks, it's $3. And in 10 weeks, it's worth $10. It's not linear like that. The value is propped up in the short term because there's a lot of uncertainty and a lot of speculation, higher volatility, all those things play into the value of options. So when you look at further out expirations, you'll see that the relative value you're getting is obviously going to increase, right? So an option that has 200 days until expiration, and that's the orange line here, is going to have more value than 100 days, right? That's just a fact. When you have more time, it's going to have a more value. It's going to be a more valuable option, but the option value isn't totally linear in that fashion. You can see the 100-day option is $4. The 200-day option is $6. It's not 1-to-1 in terms of the time increase, and that's because extrinsic value isn't linear across the board. Now, the rate of decay in those options is going to work in that same fashion, right? So if you're selling a 200-day option versus a 100-day option, the next day, they're each going to lose 1 day of time, but it doesn't mean that they're going to lose the same amount of value because those options are going to have different theta decays. You're going to have in that time frame, a much flatter decay, but when you get to like a 50-day time frame or 45, which is, where we like to kind of place most of our trades, that's when you kind of get into the sweet spot of having high extrinsic value, as well as a relatively high theta decay that starts to increase as that time passes. There's really no change or no difference in option value change in terms of raw actual value that you capture between a 150-day option and a 200-day option after 5 days, right? That's a negligible amount of time for both those options. They probably move in the exact same fashion. But when you're talking about a 50-day option versus a 200-day option and a 5-day passage of time, you're going to have a much stronger exposure to theta decay and a much greater actual realized value from that time value that has passed for that option that has 50 days to go till expiration. So just an important visual to understand here in terms of extrinsic value and in terms of how that extrinsic value decays over time.
Love it.
You have anything to add?
No, I think you did. You did very well, and you covered the whole thing. There's nothing else to say. The visual says it all.
Yes. And it also goes to why we don't sell really short-term options, because yes, your extrinsic value is relatively high, but your theta is also going to be super high, which means you have a lot of risk on the table. Theta and risk do correlate. And so, it's just another reason why we don't really deal in either of the extremes here. We're kind of in that middle range.
Indeed.
All right, so let's jump over to the last slide here. So we're talking long versus short-term options here. Long-term options will still change in value, as we talked about, but it will be mostly through directional movements, right? The value of time, of a short period of time, is a lot less valuable for an option that has a lot of time left until expiration versus one that has a short amount of time. So when you're looking at a 5-day passage of time, it is not equal between a 200-day option and a 10-day option. Those are not equal changes in time. So short-term options reach 50% of the max profit on smaller moves in the underlying and also soften moves against us. So there's less, you see less P&L fluctuation in terms or you see less P&L fluctuation for the shorter duration options, less damage on the moves against us because of the faster extrinsic value decay from theta. So you're that theta decay that ramps up from that 50-day time frame helps buffer some of the directional move that we're seeing in the stock movement versus something that's 100 days out in time where you're not going to see much, if any, movement on that position. So long-term options hold their value due to the remaining extrinsic value. Of course, this comes with the uncertainty of whether the option is going to be in the money or out of the money again. As with time, when you're talking about an option that is at the money that is 200 days out versus one that's 5 days out, there's much more price movement baked into that further out option. That option is not going to move as quickly as that shorter duration option. And that's because, you have less implied volatility, you have less exposure to implied volatility. The earnings this quarter doesn't matter for an option that's 400 days out in time because there's multiple earnings baked into there. So you're playing much less into the things that we like to play, which are volatility and passage of time, and more into directionality of that underlying.
Yep. And especially this point here with little to no IV contraction for earnings. We point this out all the time, but if you're really trying to get an IV contraction for earnings, you have to be in a near-term cycle. So somewhere between 1 day to go and 60 days to go. But it depends also on the actual layout of each product, because each product is a little bit different. So we can walk through some examples, and we can look at some of the bank stocks, which I would imagine are much more front loaded in terms of IV relative to the back months. But
yes,
yeah, definitely an important point. And don't be fooled though. Like we're saying, these options are still going to move, but they're going to move based on directional moves. They're not going to move based on time passing too much. They're not going to move based on IV expanding or contracting too much. It's going to be much more about delta and directional moves than anything else.
yes.
Yeah. And really that last piece, the liquid markets, that's another thing. So like when you're trading long-term options and you're expecting some kind of decay, if the markets for that option are a little bit wide, that width can really disguise your expected extrinsic value decay or theta decay, because you can see weird marks because of the wide bid-ask spreads and the lack of activity in those options.
Yes.